I don't know the last time I heard an investment property person talk about rent in any other capacity than thank God it covers most of the mortgage. I think that's got to influence young investors for sure into that kind of capital stuff, because that's just what they're told. That's what investing is. Investing in Australia is buying bricks and hoping that people will buy those bricks off you for more later. So if they then discover ETFs, that's probably, I think, the first place they're going to feels like investing, quote unquote. The Aussie Fire podcast is a collaboration between Strong Money Australia and Pearler, Australia's favourite boring long-term investing platform. Join our hosts, Dave from Strong Money Australia and Hayden from Pearler, as they discuss all things financial independence. At Aussie Fire, we're big fans of sharing experiences and talking about money. However, please note that any advice is general and does not consider your financial situation, needs, or objectives. Consider whether it's appropriate for you, and if in doubt, speak to a licensed financial advisor.
Hey everyone, welcome back to the Aussie Fire podcast. So today we're going to be tackling a topic that a few of our listeners have actually asked us about over the last probably 6 months or so, I would say, and maybe it's something that you've wondered too. And that is essentially, should you invest for dividends or growth when you're pursuing financial independence? So as you might know, there's a lot of opinions out there if you're in Facebook groups or talking to people in real life, or you're on Reddit or something like that. Basically, everyone's got their own sort of view on this topic and whether there's a best way or an optimal way to approach it. So today we're going to break down the pros and cons of each approach, and also the psychological aspects involved, where taxes come in, things like that. And we'll also explain our own situation and how we kind of approach this topic with our own portfolios as well. And this is not something that we've spoken about before, I don't think at all, Hayden, either on or off the podcast. So it'll be interesting to unpack because we may actually disagree here. So I'm looking forward to it.
I'm super interested in it too. I'm probably most interested in unpacking the circumstances in which different types of people might be interested in different types of approaches. Because the cool thing about a conversation like this is, while we might disagree on some things too, the answers do get very different depending on your circumstances and income and things like that.
And what's quite interesting, I think, is that there's different ways to look at these things as well. So we'll try and unpack some different angles rather than just a yes, no, right, wrong, etc., etc. So maybe we'll just jump straight in and we'll just do a bit of a quick pro and con section of each of the strategies, right? So we'll start with the investing for growth approach, focusing on capital growth and kind of ignoring income, let's say. So the pros with that sort of approach is that more of your returns are going to come from capital growth rather than income. And as we know, the capital growth is essentially untaxed for the entirety of your accumulation stage until you then go and sell some shares later. So I guess the major benefit of that is you're going to be accruing or incurring less tax along the way, which lets you have a higher growth rate, as in net returns on your portfolio. And so that should lead to slightly faster wealth growth, you would think, over time.
I think there's something deeper to unpack there, Dave, which is that tax deferment in general for people is a good thing. And the reason for that is because when you get taxed on something as it's growing, that is less of the thing you then have to grow, right? It essentially hinders compounding in some way, shape, or form. That isn't to say just because something is tax deferred that it's good. It's, if you knew something was going to grow at 5% per year and you could choose between paying tax on all of it, so to speak, at the end of the picture, or you could choose it throughout, there's kind of mathematically no time in which you'd prefer to choose it throughout, right? And that's kind of why these things are beneficial, because it's not just that you have a debt to pay later, which, is, I guess, nice in a way that it's pushed off, but it's also just that's earnings upon earnings upon earnings throughout the whole journey.
Yeah, I think that's a good way of looking at it. And when you're talking about taxes as a benefit, another aspect where a higher growth approach can be more beneficial is when it comes to if you're using debt to fuel your portfolio growth as well, whether it's using home equity or whether it's using a margin loan or something like that. And this happens with property investing as well, right? Where if you have a more of a growth approach and then less of a return from income, you're kind of creating more cash flow losses, which that can be beneficial at tax time, right? Versus a higher income approach will lead to naturally, less a tax deduction there when it comes to doing your returns and then getting cash back later, if that makes sense. So that can also be useful as well. It's essentially tax advantageous.
That's true. I mean, I'll probably say that I think of that a different way. I agree completely, but in my head, I find that idea can be difficult to grasp a little bit. In my head, I'm more like, let's say you have an investment property and you have a high income or something like that. Like if you're losing $10,000 a year to the investment property, that is a deduction. So, if you're on a high income, that's $4,500 back at tax time. But the excitement of that money you get back, I guess, is completely counteracted if you're also earning $10,000. So in my head, I kind of keep those two things separate and more just think, well, I'm gonna get that money back from the loss anyway. But if I'm benefiting from a loss because of my high income, I'm going to suffer from extra income because of my high income on this side of the equation. So, if I can, I don't want anything on this side if I can, afford to, kind of keep going, if I will. And this is kind of why, like, obviously, like if you have an investment property, because that's a concept a lot of people understand already. If you're on a high income, then you, in a large way, want an investment property that just goes up in value and doesn't really pay you much rent. Broadly speaking, I mean, that's a broad comment, but it's more that's relative to say if someone has basically no income, they love an investment property that brings them in rent, right, Dave? Because like they're probably not paying any tax on that rent anyway. And that's like a really good way to frame it. And I think this came up in a previous episode, but it does all largely depend on your income, because it's like if you have an investment property and you're getting $500 a week from rent, if you don't have much of an income, that's all money you get to pocket. And if you have a really high income, you're only going to see about $280 of that money.
And I suppose to compound that further is not only is it more, I mean, we're kind of skipping ahead here with which situations make more sense for which strategy, but to compound that effect, not only is it more, I suppose, useful tax-wise and for the lower income earner, or is it a penalty for the higher income earner to have higher income from their investments, but it's also more useful for the lower income earner, right? Rather than the higher income earner, they don't want income at all, essentially. They're like, no, I'm drowning in income already, right? That's the last thing I need. So you can see how they're going to gravitate towards different things and naturally going to be more interested in different approaches.
Yeah, and I think the other part that, people need to remember is the Australian government has this CGT discount policy, right? Like if you hold an investment and you hold it for longer than 12 months, then the tax you pay on it when you sell it is discounted. And that's a really big deal too, because you can also frame this as like if you have an investment property and it goes up by $10,000 a year in value and it pays you out $500 a week in rent. If you're, say, just take the 30% tax bracket, the average Australian tax bracket, you're going to pay 30% on that $500. So that's going to be $150 every week goes to the government in tax. This is excluding any losses and stuff, but I like to keep it separate in my head. I think it's easier to think of it that way. That's that income, you lose a bit under a third of it. However, if you maintain that income indefinitely and, that property goes up $10,000, it's gone up $50,000 in 5 years, normally you might think, oh, well, all the income I got from selling that, which was, 50 grand, I have to pay 30% tax on that. But with the CGT discount, you pay less. People think of that two different ways. They either think of it in terms of I have to pay 30% on 25 grand, or the other way to think about it is that I only have to pay 15% on 50 grand, right? But there's like a halving effect there. And some people can approach that and think, oh, that's kind of nice because if I'm kind of earning my investment through growth and I maintain the same income and kind of tax bracket, then I basically only have to pay half of it down the line as opposed to pay it all up front. And yeah, I think for some of the type of people I know are listening to this, I'm not saying that's a great policy either in some cases, right? Like a lot of people will argue that kind of fuels the housing market and things like this. That's a whole other topic to unpack. So I think that's important to flag. We're not sitting here as kind of angry, greedy capitalists being like, yeah, it's so great that you get a CGT discount. But it is just the fact of the matter. Like that's the policy that exists. And that's why people can get pushed towards those growth things because there's less of a penalty at the end. And I'll be pretty upfront, Dave, if there wasn't the CGT discount, I would probably think about growth stuff very differently.
Interesting. So yeah, so you're able to defer the tax until later, and then when the tax does hit you, you get a discount on the gain anyway. So that's not too bad, right?
Yeah, it makes it very appealing, and the impact of that naturally increases in absolute dollar terms as your income goes up. because like halving a larger amount of savings or whatever is going to have a bigger dollar impact. Obviously, relative to a richer person's wealth, you could argue it's less, but just in terms of dollars that you can buy, hot chips with, it's like it does matter more as you get more money. I spend too much money on hot chips, but
I was like, that's a very specific example, but I like it.
Yeah, that's all I'm here for, Dave. It's just to buy some hot chips. That's why I work hard.
If we do an in-person podcast, we'll have to sit around a round table with like this big box of hot chips as we do the podcast.
This is a really random thing, but I realized this last night because for dinner I went and got chicken and chips. It was like $13, right? Quarter chicken and chips. And I was like, I've realized I price chips so highly because if you were like, do you want a quarter chicken and some rice? I'd be like, for $13. I'd be like, that's a ton of money. I don't need that. But like chips though, that there's definitely a commodity price I associate with that. I'm like, chicken and a medium chips for $13? That's not bad.
And potatoes are super cheap too.
Yeah, it's crazy when someone just oiled up some potatoes and suddenly I'll give them my money. It's quite strange. But we'll unpack. We need to unpack some more spending food thing in another episode later for sure.
Yeah, the economics of chip cooking. But in theory, like this capital growth strategy, in theory, you could essentially find an investment that pays. We could do it with land, I suppose. Absolutely zero income. And then all of your return is capital growth. And if you own that forever, there's zero tax essentially, right? If you have a 0% income ETF and it's just pure capital growth and you hold that forever, there's zero tax ever. So there's no way you can have a scenario within that little bubble that is better than that outcome, right? There's zero drag at all.
100%. And, I think I'm trying to think about what are the biggest downsides of that. As someone who does a lot of growth investing, for instance, what are some of the things that give me the most stress? I probably think one of the things is like we talk about deferment and we paint a pretty picture. Oh, it's tax deferment and, you get all this compounding. But the downside is that you've never really gotten the benefit yet. That's the problem with all this deferment. That's the problem with the unrealized stuff is, if you've invested and you've seen your portfolio go up by 10% in a year, you're like, oh, that's so amazing. But it can literally go down by 10% overnight. It could be tariffs or something like this. So there is like an anxiety that I think is baked into growth stuff, which is like, it really all is just about what's the price someone's willing to pay for it, which you don't get with income stuff, right? It'd be like, imagine working a job and every single year your salary goes up, but you're not really going to get paid till you quit or something, It's like kind of scary because you don't have it yet. And I think that's probably the biggest thing I don't see people talk about a lot with growth stuff. The same applies for investment properties as well, but it is just quite anxiety inducing in the meantime, or it can be, I guess is the point.
When you think about it, all money that exists, whether it's in a portfolio account or a bank account, it's all kind of like theoretical spreadsheet money until you actually use it, right?
Yeah. Yeah, and I think as well, I want to maybe counteract that. It's a bit of a nuanced point, but I started doing a lot of investing again about 2 years ago, and my portfolio is up like 21% or something, which is not unreasonable in that time frame. And I think there is a benefit of like, now that it's up 21%, I just know based on historical trends and what economies are likely to do that I know that portfolio is not going to go into like the negative numbers for an extended period of time at this point, because like you've seen this with most growth markets, if there's like a flash crash or COVID or something, they can go down. They can go down 10, 20, 30, 40%, but they'll usually recover not too long. It won't take them years to recover. Who knows what the future is going to hold? That's an important disclaimer, obviously. But I think the scariest part is those early days for me, because obviously like if Dave has a growth portfolio and it's up 80%, the likelihood that Dave's going to see his portfolio go negative compared to when he first put in his money is exceptionally low. And there can be some like comfort associated with that because it's just shades of how much money you've earned. Whereas I think the early days of growth investing are some of the scariest because you could just end up poorly timed the market. And we talked about this in the last episode about, when is a bad time? Is there a bad time to invest? The market's really hot. And I think there is that stress still just based on the early stages of investing.
I think what you're touching on there is something that I've noticed or that is my observation when it comes to a more growth-focused approach. And that is because you're expecting or hoping that a higher proportion of your return comes from capital growth, that means you're way more reliant on that price growth, right? So that's what you're going to focus on all the time. And if you're focusing on prices all the time and prices are moving all the time, that's going to lead to a more anxiety-inducing experience of your investments, I would say. And it's going to make downturns feel a lot worse than someone who's focusing on the income side of their investments. And then if we go back to the negative gearing aspect, if you've used debt as well, that's going to just make that feel 10 times worse, because not only are you losing money cash flow wise, you're also losing money on the price angle as well, right? So it's kind of this double negative extra stress event. So that's...
Yeah, and I can put that into perspective, Dave. I think one of my split parts of my loan, which was like $200,000, I debt recycled that pretty early on when I got the apartment. And what that meant was I could have offset this loan fully and avoided paying about, I don't know, like hundreds of dollars. Call it I'm sure I might be off by a bit, but like call it $800 a month in interest or something, you know? And I could avoid paying that $800 a month in interest by offsetting it, or I could invest it. I invested it. And at first it was great because I saw the portfolio go up a little bit and up a little bit. And I was like, oh, this is worth it. But then there was a period for about, I think, 2 or so months after I started that where it went down pretty sharply. It was just a bad few months, right? And I bought in at like a local peak. And I was sitting there every day watching this thing, and I was like, I'm down $1,000, I'm down $3,000, I'm down $5,000, I'm down $8,000. And all I could think in my head was like, I am paying $800 a month for the privilege of watching my wealth go down, you know? And yeah. I knew it would be okay in the end, but like it doesn't take away from the fact that like that's just paying to watch your money evaporate is just a crappy feeling. That's just a very, I guess, human comment on the stuff Dave's making about like if you're investing for growth with some, and again, the same applies for investment properties. I haven't had that experience, but I mean, Dave says he's invested in the housing market in Perth at a bad period, but I can't even imagine what it's like to like buy an investment property, have people live in it, they're a headache, you're losing money every month, and then someone revalues the house like 20 grand down, and you're just like, what in the hell am I up to at the moment?
Yeah, it's not much fun, man. I was in that situation for quite a few years on the Perth property side of things. So yeah, definitely not much fun. You have to have quite a lot of patience, I would say, to sit there and stomach that for like 3-5 years and then just think, okay, it's not going to last forever, obviously, because you believe in cycles and that things turn around and have their ups and downs. So yeah. It's quite an experience, and it does change how you feel about your investments. It changes that quite a bit. So yeah. So if we just talk about the income side of things, right, and having a more, let's say, dividend focused approach, because we mostly talk about shares here, I find the main benefit of a dividend focused approach, and as someone myself who's done more income investing than growth investing, so we're kind of on the opposite sides of the scale there, Hayden. I find it to be more getting a regular income from your investments makes you less reliant on the price growth, which kind of makes the investing experience less stressful. And I also find that and especially with the first 3 to 5 years or so of your investing, the regular income that you're getting from your investments is almost like a strong level of positive reinforcement that you're doing the right thing, right? You're getting a short-term benefit, let's say. So it's almost like notching up quick wins essentially from your investing, right? If I put in some money and then I get a dividend, okay, great. I'm going to put in some more money and I'll get a bigger dividend. And you kind of see how this machine of the stock market works. And you think, okay, well, if I just keep putting in more money, I'm going to get bigger and bigger chunks of income, and that's going to eventually like pay my bills, right? So you find that to be motivating and have that positive reinforcement as well, I find.
I think the best thing about income investing is that, you know, maybe this is too broad a brush, but I don't think so. Everyone wants to eventually be an income investor. You know, like at some point you're going to have no occupational income, employment income, and, you know, you're just going to have an investment portfolio and you want it to pay you stuff. You know, like there's no retiree out there that's sitting there on like a really expensive home, a 10-bedroom home, making bugger all rent from it. It's vacant 3 months a year, being like, yeah, but at least it's going up a lot, because they're like, I need the money. Like that's why they invest. They want to.
I need cash flow right now.
I need cash flow, yeah. And it's the same with ETFs, right? Like if you're 70, you're not going to be like going hard on NDQ or the US stock. I mean, some people will, no doubt, but like you just want something that pays you an income. And I think there's something nearly romantic or exciting about doing that early on. is it's where you're going to end up. And I think most growth investing I see, at least, and again, I might be making a broad brush here, it's like a stage of the journey. It's like, okay, well, this will last 10, 20, 30, 40 years, but at some point I'm going to have to shift this to like an income focused stuff. But I think there's just something really cool about, and I think Dave is probably someone who's participated in this, like buying VAS or some other kind of, higher dividend ETF and just being like, no, I'm just going to buy this now and I'm just going to build it up and that's my portfolio. That's just like I'll keep this for a very long time. And I think a lot of humans are like that. Like I think there's also something kind of crummy about buying a home, knowing you're just going to sell it in 10 years. Like we want to buy a home and be like, we're going to keep this forever. And everything if I put into it, if I paint the walls, it's kind of like a long-term thing. So I think there is just like a real warm element about income investing, if that makes sense, Dave.
It does make sense. I think when it comes time to, like you said, when you're wanting cash flow later, that kind of strategy is more, let's say, it's just easier, right? You don't have to do anything for one thing, right? So if you've got this portfolio and it's just paying you this automatic level of income, there's no action required on your part. So it's very simple. And because there's no action in regards to selling shares, because obviously if you have a growth focused portfolio, you can still live off that and get cash flow from it, but you're going to have to sell chunks of shares every month or every quarter or every year to create that cash to live off. And that basically is going to work out the same, right? If you're selling 2% of your portfolio in a year, it's going to be the same as getting 2% dividends per year, right? Because if we expect those portfolios to have the same level of total return, then it's going to be basically the same, right? So the only thing with that is along the way, the income approach can attract more tax, right? Because you're, like you said, Hayden, you're not deferring it. You're getting some of those returns upfront in a taxable way. So that can slow down your wealth growth. So it's almost like you're paying let's say you're paying a fee for the psychological benefits of building up this income stream along the way. And I suppose you can start using that income stream. So it's more, I suppose, functional or practical if you're maybe in a lower income scenario or maybe wanting to use that to pay bills in your life along the way, different things like that. So there's that side of things. But yeah, I've noticed that retirees especially, almost nobody wants to actually sell shares to create income. I don't know if you know people that's kind of in that situation, Hayden, but everyone I know just wants to get dividends or rental income or interest or something like that. There's this big psychological hang up around selling shares, even though the maths, doesn't really change.
Yeah, I think that's pretty accurate. And I think people I've seen who do it, a lot of them are just ones who believe so heavily in certain ETFs. Like they're just like, I have such a heavy faith in the NASDAQ 100 that it would be crazy for me to put my money anywhere else. But yeah, I mean, the problem is that if a dividend goes down, like that dividend went down. Whereas like if you've invested for a long time and you sell it out to get that cash flow, it's just hard because what it means is that for you to get your $1,000 a month, if the stock market crashes by 40%, you now have to sell out like 1.8 times the amount. Like that's the psychological hang up, I think, to some extent. I think there's two parts. Obviously, people don't like selling stuff. Like, if you ever talk to an old person and they're like, I have no money. And you're like, why don't you just subdivide your property? You just have grass at the back. Like, let someone else live there. They're like, no, I worked hard for this. Like, there's that element, which is like people don't like to lose something. But I think the other part is like, it's hard knowing that if the market volatility just affects how much of yourself you're eating away. And I think that unpredictability is really hard. Like, I don't mind, if I have something, like I went to Japan, I bought 10 blocks of chocolate and I know I'm just going to have to eat one a week and then I'll, eventually run out and I just try and pace it. But my God, if like just randomly on some days, it was like, you have to eat 2 blocks of chocolate to like get the same chocolate. And that like, I would just find that really crappy. Even if I got past the, like, I'm eventually going to run out of this or I don't like destroying what I've created or something, maybe a terrible analogy, but the volatility, I think for me is where I would get hung up on it the most.
Are you hungry by any chance, Hayden? This is a second food analogy during this podcast. We're only like 20 minutes in.
Probably if I thought about it, but let's not think about it.
Yeah, so when it comes to living off the portfolio, I think even in theory, if the selling approach and harvesting gains works out the same, to me, it doesn't come with the same level of like psychological certainty as someone who's going to have this portfolio and only live off the income. because the way a portfolio works in retirement is you're getting the income. Okay, fine. When there's a recession, that income will be cut. That income is not going to be the same. Like if you're getting 50 grand a year dividends, it's not going to stay 50 grand a year. If companies are like getting their earnings slashed and stuff, they're going to reduce their dividends because they can't afford to pay the same level. So that income might go down to like 30,000, right? During a recession. So that's going to hurt. But the advantage there is you're basically with a dividend focused approach, you're forced to be flexible because the income goes down naturally during downturns. And so you have no other choice but to make up for that money somehow, some other way, right? Whether it's using a cash buffer or whether it's spending less or something like that. But you have to plug that gap or adapt yourself to the situation. Whereas if you're just selling a certain amount each year, you don't have the same level of psychological certainty. You would have to try and mathematically exactly adjust your share purchases for the same amount, right? Which almost nobody's probably going to do to that extent, right? So it's not quite the same level of psychological certainty where if I'm never selling, my portfolio can never deplete. You just have that forced mechanism in the dividend cuts that makes you essentially, it would be the equivalent of being forced to sell a lot less of your portfolio during that downturn. But as you're saying, Hayden, you basically have to sell more.
Well, it's funny you say that because now you're making me wonder. There might actually be scenarios where selling down is easier because I think about it and I'm like, you know what? Like we're about to launch a new feature on Pearler where you can automatically sell, right? And
that's good. I asked for that like 2 years ago, man.
No one has asked for that except for you. That's why it's happening.
I'm
sure people think about it.
This is the kind of scenario I'm thinking of, right? Automatically buy, and then one of the biggest hurdles people have is not wanting to physically sell their shares. So if you set up like auto sell, so then they can just drip feed a little bit out of the portfolio, maybe in addition to getting their dividends, I think that's perfect for like a growth heavy portfolio. And then no one, they don't even have to log in and look at it. They don't have to physically place the order. It's going to be a lot easier for a lot of people, I think.
That's kind of what I'm getting at is like, I'm just as I'm thinking through this as we're talking about it, there nearly seems like something more nice about, in Pearler or wherever you can sell, having a thing where every 2 weeks or every month it sells $3,000 of your ETF. Like clockwork, every month. It doesn't matter what the stock price is, it just does it once a month. And then it sends that to your bank account. And then you get something in your bank account every month. Because one of the problems I still have with dividends is like, there is a little bit of financial accounting you still have to do with it. Because like, you get it this one, and then there's some on this date. And then if you got a few ETFs, they pop in at different times. And then you might have to think like, how much is that? Now, that's probably not a real scenario because obviously someone like Dave is not sitting there living paycheck to paycheck. Dave's got a big cash buffer and the dividend money just comes in and it's just trickling on top of his, massive fortune, I guess. But I think that I'm overstating the relevance of that because most people don't, specifically care because they have a cash buffer. But there is something quite easy about just selling the same amount out all the time and having that predictability and just knowing that you're probably going to sell some at market highs and sell some at market lows and, hoping it all just works out in the end.
I think the more you can do to try and remove yourself from having to look at your portfolio and actually transact, especially in a state of semi-retirement or retirement, the way more likely you are going to be to stick with that approach and enjoy the experience of not only investing, but actually in retirement rather than stressing out a lot. Because, you can look at spreadsheets and probabilities and stuff like that, but like 95% of people don't work like that, right? 95% of people are not like spreadsheet junkies and maths nerds and stuff like that. And they don't know like all of the cycles of market history or whatever. So they just want to feel comfortable and secure in their investments when it comes time to live off them, because arguably that's like the most important time, right? That's crunch time. So whatever you can do to make that experience less stressful and more practical to actually stick with, unless it's something crazy, is probably going to be useful.
I think that makes a lot of sense. I think when I kind of take a sidestep from that and think about, we've kind of given a lot of scenarios. How do you figure out what works for you? I'm trying to think about some quick rules I would have. I mean, probably one of the biggest things I'd say, Dave, or probably the two things is like the less you specifically need income to manage the day-to-day or month-to-month, and the more money you earn and therefore the tax you pay, those are the two biggest elements that would push, I think, an investor towards growth stuff. again, it's very difficult to say, who's what for what, but I think they're the two kind of variables that push people in that direction. I think it's worth pointing out too, a lot of these conversations we're having are also assuming that like growth and income investments are like mono v mono, and that's just how you get the money's different. But a lot of investors out there do have the view that they don't even get that far, because honestly, like I know a lot of people, and I'm not saying they're right, but I know a lot of people that just invest in the US and by proxy are doing growth investing just because they believe in it so much. They just think it's going to outperform Australia dramatically, and they don't sit around being like income this, whatever. They're just like, that's where the future is. And I guess that's fine. Like if you've got convictions with that stuff, that's fine. We've all got views on it. But I think a lot of what we're talking about is very like, if there's a US ETF that's growing at 5% per annum versus like an Australian ETF that's paying dividends at 5% per annum, like not exactly to the point, but we're kind of trying to separate some of the, the fact that some things will just return you better no matter what, no matter how they're giving it back to you.
Yeah, we're trying to focus on the principles rather than the specifics, right?
Yeah. I
think that's fair to say. I do think there is a lot of people, like a good percentage, that are just wanting to invest in high growth, aka US shares specifically because they're expecting more or less permanent outperformance. And that may or may not work out to be totally true, but people are just essentially chasing where they think the best returns are going to be first and foremost, I think.
I think it's a cultural problem too. Like, you're right, but I think it's like the whole psyche of how Australians grow up as hearing their parents be like, I bought this property back in 1998 and I sold it and it went up this much. Like, when was the last time you heard your parents come home and be like, rent check came in? Hell yeah. Like it doesn't really happen. Like, I don't know the last time I heard an investment property person talk about rent in any other capacity than thank God it covers most of the mortgage.
That's because property in Australia tends to be a capital growth play rather than an income play.
For sure. And I guess my point is like, I think that's got to influence young investors for sure into that kind of capital stuff, because that's just what they're told. That's what investing is. Investing in Australia is buying bricks and hoping that people will buy those bricks off you for more later. So if they then discover ETFs, that's probably, I think, the first place they're going to feels like investing, quote unquote.
No, I think that's fair. That makes sense. Just on the, we're trying to speak in like for like terms, right? But it does matter which system you're in. So the US system in terms of taxes and how dividends are treated and stuff is very different from the Australian system. So I think everyone that's listening to this will be aware of that, and that you get franking credits on your Australian dividends from Australian companies, which obviously reduces the amount of tax you're going to pay on those dividends, often quite substantially. And then in retirement, you're potentially going to get those franking credits refunded, which means you can receive a pretty decent income stream, essentially tax-free up to quite a nice amount. But it goes one level. Like, I find people will look at that and be like, okay, that's nice, but if I still have to pay some tax along the way, that's worse, because they're looking at the tax treatment on an individual level, but it also goes one level above that to the tax treatment at the broad level, to where if you measure $1 of earnings from like a US company, the minimum tax rate's I think it's like 21% in the US. So then there's 79 cents left. And then if they pay any dividends at all, then they're going to be taxed at whatever personal tax rate's going to be in the US versus here. Here, you're going to be taxed, whatever, 37%. You might be left with 50 cents. Of that $1 of earnings that passes through the US company to you here, you're going to get 50 cents, which is not great. And the minimum you can the maximum you can possibly get is like 79 cents. But if $1 passes through an Australian company and goes to you, and you basically get 70 cents, you get a 30-cent franking credit for the tax that they've paid. You can essentially receive $1 of earnings from the company to you and be able to spend that $1 and have it taxed at 0% if you're in a state of retirement, let's say. But the minimum tax rate in America is going to be 21, even if you pay zero tax on the dividends. So it's not the same $1 of earnings as it flows through the system, let's say. So I've never seen anyone really speak about that before. Everyone's just focused on like the individual level rather than the broad system-wide level of how the money flows through.
I think that makes sense. And I mean, on franking credits, I'm sure a few people have been fuming if they made it this far because we hadn't talked about it yet. I think one benefit of franking credits, first up, is that the amount of franking credits you get, the amount of, I like to think of it as, cash back at tax time it's agnostic of your income, right, Dave? Like it's purely based on how much of the ETF is in Australian companies. So like that's one cool thing about it is like like a lot of stuff with tax tends to be if there's a tax penalty and a tax benefit, both of those things go up and down with your income, right? It's kind of the case with like if your income's really high, you have to pay more tax on your rent, but you get more benefit from your negative gearing. But franking credits are kind of cool because as your income goes down, your franking credits are still the same. That's why they're popular with retirees and stuff like this, because you actually get a tax benefit with zero income, which I can tell you is not very common from everything I can tell. I personally will flag, I don't think about franking credits a lot because I find that a lot of the growth options that exist out there have performed better from my reading in like raw terms. And all I see as franking credits are just this benefit that income Australian ETFs have, which just helps make it more comparable, So I don't see it as like a whole factor I factor into stuff. I'm more just like, well, that's good. It just means that it's probably more like 5% income or something like that. And I don't have to because otherwise, if you're starting to look at like 9% historical returns on US markets in growth versus 3.5% income in Australian stuff, it's hard not to just like lean one way. I just made up some numbers, by the way. But yeah, so I don't think about them a lot. A lot of people seem to give them a lot of time. I just think it levels the playing field a little bit. And also people need to remember that's why Australian companies tend to do that a little bit too, is pay some income because of the tax incentives. Like you watch tomorrow, if the government came in and was like, we're getting rid of franking credits, companies would very quickly be like, we need to make shareholders happy. Now, if we do the same thing, shareholders are going to get way less money and they just start doing different stuff. Instead of paying out profits, CommBank would start acquiring more companies and trying to increase their stock price through, increasing capitalization and stuff. So that's just a side note, I think, about why there's such a big difference in Australia sometimes.
Yeah, it is quite interesting if you unpack it like that, because there would definitely be changes to probably how the companies manage their money if franking credits were to be capped or abolished or whatever like that. So they might start buying back their own shares, as American companies tend to do, because a stock buyback is basically the same thing as a dividend as well. So instead of paying you a 2% dividend, they increase your ownership by 2% by buying back and cancelling 2% of the shares or something like that, right? So you could think about those things interchangeably as well. So that's partly actually what drives higher earnings growth as well and higher stock prices. So that's a factor. That could happen here as well if franking credits were to be reduced or abolished as well. Companies would have to look at that. But some of the talk around dividends, like people get very passionate towards like essentially being annoyed or frustrated or like hating dividends because they can be taxable in many cases, right? So I noticed that some people often wish there was a scenario where companies didn't pay out any dividends and then just kept it all and just like basically tried to use all of that money for growth, right? But if you think about it a bit more broadly, companies don't have an infinite lifespan. So if companies don't have an infinite lifespan and then they also do not pay out dividends and then they eventually disappear, where was the value in the company? Was it just holding it for that time it was around until it disappeared later? I think the average lifespan is like 10 or 20 years, right? For a large, maybe not a large company, but a listed company, right? So they're not infinite beings that's just going to stay around forever. So I do think having a dividend policy and paying out dividends on a company level is useful because it forces companies to be more fiscally disciplined with how they manage the wealth of the company. Because otherwise, if they're just being pushed to try for more growth, they end up spending money on a bunch of dumb shit. I think we could all agree that giving a company like a blank check with their earnings is not going to lead to the best outcome a lot of times.
Yeah, I completely agree. And I think this whole topic we're talking about, I think that's why there is a lot of benefit in not seeing this as a binary question either, but like investing in both, right? Which is something like we've talked about before. And I know we were going to talk at some point in this episode about, what we're respectively invested in, but this might kind of tie well together as like when I look at my portfolio right now, I would say that approximately 70% of my money's in growth stuff and 30% in income, right? And that's mostly spread across like IVV, VGS, and VAS, really. There's some DHHF there that I bought a while ago, but I kind of decided to split that up. But yeah, it's basically a mix of like direct US, VGS, DHHF type some globalish stuff, and then some Australian things. And, I'll be totally honest, like when I look at things purely from like a principled mathematical standpoint, based on my income, based on my needs to service loans, based on my cash flow, growth stuff, and particularly stuff that trends on the US, or any other kind of like rapidly growing market is where all of my money should be, right? However, I don't think I'm emotionally and psychologically mature enough to go all in and then have something bad happen to that market, right? Which it can happen. So it's around about a quarter. That's like my rough aim. Around about a quarter of my money sits in income stuff, not high income stuff, but like, VAS or something like this, purely just to feel like I've got some kind of protection, purely so that if everything goes to absolute hell, and Australian income stuff tends to be a bit more protected from the consequences of that in the short term, that I'll feel a bit better, and like that's a genuine thing. And it's not just that you feel better, because obviously, like, if war breaks out in the South China Sea, VAS is going to go down too. Like it's not like these income stocks are like wee, where just like do whatever. They go down as well. But what I'll have is I'll be able to, whilst I'm crying, log into my app, and I'll be able to go look at all the dividends VAS has paid me over the last 2 years. And I'll be able to be like, this effort, this risk I've taken, it has manifested, it has realized itself in some ways already. So it kind of protects me against, what's going to happen in the future. But again, I'm just saying that, again, I'll be very honest. It's very emotional. It's very much me trying to protect against myself and my reaction and feeling to things that could happen in the world. That's why I dabble in both, I guess, is the answer.
Yeah. It's interesting because my portfolio is almost the opposite of that, where I'm moving towards like a 50-50 split of Australia and global, but it's currently like maybe 62 or something. I have to check it, but it's like 60 something Australia. And then the rest is global, because I started with a 100% Aussie portfolio, right? So, and I'm slowly moving. Yes. Let's do it. And but it's interesting. I look at it a little bit differently in terms of income versus growth. I now look at it more in terms of markets, right? So I think one of the problems with not with the growth approach necessarily, but with the fact that people are trying to look for the highest returns, is you can't know that the US is going to continue outperforming forever. I don't think that's a fair assumption to make. It may not, but that's going to underperform as well at some point. So it's going to depend on how much conviction you have in different investments. But I just start with the assumption that the market is fairly smart and that US companies are already priced quite highly because of how good they are, so that we shouldn't expect much of that, massive outperformance to continue versus every other country forever. I think that seems... Yeah.
So you've got kind of like a bit of a unopinionated hedge, I guess I'd call it. You're trying to hedge, you're like, this one, I don't know, let's try and have, 50-50-ish. I'll keep it pretty balanced because like I just don't really have some view that like Australia is going to be the center of the world. Yeah, I don't know. Yeah, yeah, exactly. Yeah. But it's interesting because like I have a little bit of a view. I think the US market is overcooked and I think it is a bit inflated, but I also do have a genuine belief that, as much as I have a lot of issues with that place, that they're just the best set up to keep dominating, right?
Yeah.
And I'm not saying that's true.
It just depends on how concentrated you want to make that bet, I suppose.
100%. Yeah, exactly. And I say a joke to Dave, and I'm not joking, but every time I watch the US market go down, I just look up a bookmark video I have of Warren Buffett in an interview being like, "Don't bet against the US." Anyone who's ever bet against the US since World War II, I said that in another episode, and I just play that on repeat because I'm like, just G myself up. Because
I bet you every time the market goes down, if you look at like YouTube analytics or searches for Warren Buffett talking about the US, it would go up. It would be this inverse correlation. People want this reassurance.
To Dave's point, like there is truth in that, like the US is, since the 1900s, maybe before that, my knowledge of history is not that great, has just shown that, whether it's geographically, politically, culturally, it's set itself up well to just continue to prosper, in a way that we haven't seen countries do for a while. But to Dave's point is like, yeah, I'm not saying that's not true, but how do you know we're not going to look back in 500 years and be like, that was a cool 150 years of, the US's reign before the great thing happened? Like, that's the problem, So whilst I take these light bets, you'd call it, why it's not 50-50, you got to go in knowing that we're all idiots. And we like to have convictions on things. That's the reason we buy houses or rent in suburbs. We think it's a better suburb. And it's like, that's an unknowable thing. And people be like, this suburb's really prime. Like, I have friends who are buying property out in Western Sydney being like, it's the new future of Australia. And I'm like, maybe not. There's 100 different ways that could go one way or another. So as long as I think you always go in knowing that we're all pretty just big guesses, that's the healthiest thing.
Yeah, a bit of humility goes a long way, I think, because I think the most arrogant people in the stock market are the ones that get absolutely smoked and they end up looking stupid after 5, 10, 20 years later. So I think that it makes a lot of sense to have, even if you want to have a more concentrated portfolio and you're very convinced about something, you probably don't want to bet everything on one factor and you want to have a little bit more balance and a bit more of a diversified portfolio so that your long-term outcome and especially your financial independence goals aren't reliant on a single factor or a single country and a single bet working out really well over your time period.
Yeah, exactly. And it's good to learn, like even just hearing Dave say this stuff to me, even whilst we're recording this, I'm sitting there being like, maybe I've made a mistake. Because it's hard logic to fault. Like, it's like, why would you really think that a fully diversified portfolio is better? And I don't think there's ever going to be a good reason than that. Then it's kind of fun to have opinions in life. And I stress the word fun because I don't know if it's smart. Can be smart, but on average, I don't know. But I mean, that's enough about me and my existential crises when it comes to investing. I was talking about growth or income, both are good. You talked about your portfolio a little bit. So just to clarify, you were 100% Australian and then you went to 60, you're at 62 now and you're trying to get to 50-50, or were you at 50-50?
No, I was never at 50-50. So I started 100% Australian when I started investing in shares in 2015. So I basically started putting money in and then getting some dividends. I'm like, this is pretty good. If I have enough money in, because the dividends in Australia are pretty good, right? So I was thinking, if I have enough money in here, I can retire. Like, I can just live off this. So let me just start parking all my money in here. And I was like, I'd rather get the income because I'm gonna want to live on it pretty soon. So let me just focus here. And then left work and then kept building the portfolio like that. And then started to realize that more diversification would make sense and wasn't super comfortable with the idea of selling shares. So never really wanted to do that. But then as I got more experience and understood the benefits of diversification and not kind of betting on one country and one outcome, got a bit more of a diversified portfolio, then I'm like, okay, I can see the point of harvesting some capital gains for income. Because obviously it's just another source of capital that you can draw on, right? And you can see it as optional if you're already getting some income from your portfolio and you're flexible and different things. So yeah, I felt more comfortable with that. So just basically slowly started to build the portfolio up to where it's, a third or maybe a little bit more than a third global now. And it'll probably get to 50% or something and see how we go from there.
That makes sense. I think it's worth as well highlighting to people, because I feel like a lot of our customers don't know this, but this term distribution, when people say dividends versus distribution, we've talked about this on a couple of episodes, but just to rehash for people, distributions are a term associated with ETFs because when you get that money hit your bank account or wherever, some of that money may be from dividends, company profits. Some of that money may be from an ETF having to pass on capital gains. An ETF is a trust-like structure. It can't hold money. So any money it earns or it has to pass it all through to its beneficiaries is what you are. And what happens is you imagine a scenario in which, Tesla stock keeps going up and up and up and up, and this would have happened, or down or something. The ETF, their only job as a fund manager really is to buy and sell the underlying shares. When you hear things online, where you say BlackRock's one of the biggest owners of companies in America, it's yeah, because people keep buying BlackRock ETFs. And then BlackRock, like they have to buy more company and stuff like this. So
that cracks me up as a side note. People like BlackRock own the world and Vanguard own the world. It's like, I don't think you understand how these things work.
It's like in a way, because obviously like if we all invest in if we all invest in Vanguard and Vanguard has to buy Tesla, then Vanguard's a big shareholder of Tesla. So in theory, Vanguard has some controlling abilities, but like that's as much as anyone on any company that can control it. And remember, any person who represents shareholders has to act in the best interest of shareholders anyway. Like they're like legal requirements in most regulated markets. But point is, when you get that dividend, it's often a distribution, and especially if you own things like VGS or NDQ, often a large amount of what you're getting paid is actually capital gains tax or gains or something that's being passed on to you. And typically, so what that happens, I'm an ETF, the market moves around, I have to sell some Tesla and I have to buy some Amazon. Wow, Tesla's so much higher than when we bought it. So we made a bunch of money, the ETF, but then we have to pay tax on that, but they don't really facilitate that. They take your portion of the amount that's earned and your portion of the tax you have to pay, and they trickle that to you. And I think this is like a comforting thing to some extent with people, is like, when you invest in things like VGS and you see things like it's a high distribution or something, and you're like, oh, I don't really know how I feel about dividends or income. It's like often it's just capital gains brought forward, and then that comes with tax benefits too. And I'm not really, I guess, saying so much as like to read into this. I don't really read into it, but it's just worth understanding that when you see VGS is at like a 3% distribution last year and VAS is at a 3% distribution, the way that money's coming into you is very different, and you can't just generalize it all as like that's profits. But as a consumer, it's kind of all still income, but then some of that income you pay normal marginal tax rate on, and some of that income you pay capital gains discounted tax on, which is that awful form you get from like Vanguard or whoever at tax time with all the numbers in it. That's all that. That's them breaking that down. Into all those little pieces. And if you look at it now, you won't be able to unsee it, because you'll see things like capital gain, and then you'll see discounted capital gain, and then it'll be half the price. And then you're like, oh, I know what's happening there. I get it. So that's just, I guess, a bit of background for people. Yeah,
they're pretty convoluted, some of those ETF statements, aren't they, mate? Not the most user-friendly things to look at.
So I think they're most of the topics we wanted to chat about, Dave. I think just the kind of key summaries from our conversation here is we contrasted income versus growth types of investments. We highlighted that, growth investments, they have this capital gains discount, they defer tax, which are all good things, but they also come with this unpredictability of like, you haven't really earned anything till it's there. And there's a lot of comfort that income type of investments bring. There's a lot of psychological comfort or emotional comfort, some certainty associated with it. And often it's part of what a lot of people's long-term plans are, is to get income as well. And that's excluding the whole conversation about franking credits too. We kind of posed the question about, what's the right strategy? The thing we talked about at a high level was that as you earn more money and as you need income less urgently, it generally will push people to growth ETFs. Though that's a broad statement, and it doesn't mean that each individual person is going to be more motivated by that outcome. It's just when you look at averages, which is important to understand trends, but still know that these decisions are fundamentally about you and your circumstances. And we also talked about how Dave and I, even though we might have views on this stuff, we both still invest a lot of our money in, at least a quarter of our money each is in one of income or growth stuff, and the importance of diversified portfolios, because taking concentrated bets of any kind, particularly when you're not omnipotent and understand everything about the world and can predict the future, always carries some kind of risk. And that's just a general recommendation we'd have is, it's never the best idea to go all in with any kind of investment that's quite concentrated.
Yeah, well said, mate. I think that's a good summary. I think we'll probably leave it there for today. So guys, if you have any more questions around this topic or similar topics that you'd like us to discuss on the show, you can always reach out to us either on socials, Perla or myself at Strong Money Australia, or you can send us an email at our email address, hello@aussiefirepod.com. And we'll hopefully get to your topics and your questions in future episodes. But yeah, let us know what you think about this topic, how you approach it for your own portfolio. We'd be really curious to get your thoughts. But that's it for this one. Also, we'll see you next time.
Thanks, everyone. We hope you enjoyed this episode of Aussie Fire. For more FI inspiration, head to Pearler.com to browse our resources, calculators, and community insights. Pearler is an authorized representative number 1281540 of Sandland Private Wealth Pty Ltd with AFSL number 337927. Knowledge is power, especially when investing. So always seek advice and/or check out the relevant disclosure document for any financial product, including the PDS and TMD before deciding. These are available from the product issuer's website. When you invest, your capital is at risk and past performance is not a reliable indicator of future investment returns.